Hi everyone, in this video we'll be going over A-Level Accounting 2022 October-November Paper 2-3 question number 1. This is a structured paper 2 which consists of 4 questions. 2 of them are of 30 marks and 2 of them are of 15 marks, and we are given a total time limit of 1 hour and 30 minutes. And this question number 1 is of 30 marks, so ideally we should be spending about 30 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. Reese, a sole trader, does not maintain a full set of accounting records. He has provided the following information for the year ended 30 June 2022. Alright, so we're given the amounts at the date of 30 June 2022, which is the ending date, right? And we have the amounts at the date of 1st July 2021, which is the beginning date. Okay, then we are also given the bank account summary as well as some additional information. Let's have a look at the additional information. Total cash sales for the year were 15,280. Reese had also paid cash for wages during the year but had not recorded this. Okay, so the wages paid by cash is not present in the above information. Then Reese took 450 per month drawings before the cash sales were banked. And he had also taken goods for his own use with a selling price of 350 after a markup of 25%. So let's figure out the cost price of this good. We know that cost times 1 plus markup percentage, which in this case is 25%, so we can write it down as 0.25 equals to the selling price, right? So that's cost times 1.25 equals to, and in this case we have the selling price of 350. So now we can easily figure out the cost price. That is just going to be 350 divided by 1.25, which results in 280. Alright, then during the year, machinery that had cost 6,000 on 1st July 2019 was sold. So this is the disposal, right? And machinery is to be depreciated at 15% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase, but none in the year of disposal. Okay, so let's talk about this disposal of machinery. It was bought on 1st July 2019, right? And our current ending date is for 2022. So this is 2021, this is 2020, and this is 2019. And we are disposing this machinery at the year ended 30 June 2022, and we are also told that no depreciation should be charged in the year of disposal. So we do not have to charge any depreciation for this year, which means that for the sold machinery, we only have to apply the depreciation for 2 years, right? So let's figure out the first year's depreciation. That is just going to be the purchase price times our depreciation rate of 15%, because since this is the first year, there is no accumulated depreciation, which means that our net book value will be equal to that of the cost. So that's going to be 6,000 times 15%, which we can write down as 0.15, which results in the amount of 900. Now let's figure out the second year's depreciation. For the second year, the accumulated depreciation will be the depreciation of last year. In this case, that's 900, so that's 6,000 minus 900. This gives our net book value. Then we can multiply it with the rate of 15%, which we can write down as 0.15. And this results in an amount of 765. So the total accumulated depreciation for the disposed machinery is 900 plus 765, which results in an amount of 1,665. So let's figure out the net book value. That is just going to be cost minus accumulated depreciation. In this case, the cost is 6,000, which is given right here. So that's 6,000 minus the accumulated depreciation, which we just figured out. That's 1,665. Now this results in an amount of 4,335. So this is the net book value. Now, if we have a look at our bank account summary, we can see that the sale of machinery bought in cash of 4,000, which is lower than our net book value, which means that the sales proceeds is lower than net book value, which results in a loss on disposal. Let's figure out that loss. That is just going to be net book value minus sale proceeds, and in this case the net book value is 4,335, whereas the sale proceeds is only 4,000. This results in our loss on disposal of machinery to have the value of 335. Okay, this concludes all of our additional information. Now let's move towards the first part of this question. We need to calculate the total credit sales for the year ended 30 June 2022. Let's have a look above. we can see that the credit customers paid the amount of 149,810, right? Then we can also have a look at our trade receivables. At the beginning date, we had the trade receivables of 23,580, and this is resulted by the credit sales made at the year ended 30 June 2021, which is the previous year. And this previous year's credit sales should not be included in this year's credit sales, right? So we need to subtract this amount from the total amount that we received from credit customers. And then the trade receivables for the year ended 30 June 2022 is 20,620. This just means that we already sold goods worth 20,620 but have not received this amount yet, which means that this should also be included in our credit sales for the year, right? Then we will be adding this amount. So the total for our credit sales is just going to be the total amount that we received, which is of 149,810. Then we need to subtract the previous year's credit sales value that we received in this year. So that's minus 23,580. And then we need to add the credit sales amount that we have not received yet for this year. So that's 20,620. Let's write it down. We first start with the total amount that we received from credit customers, that's 149,810. Then we subtract the previous year's credit sales, which was of 23,580. And then we add the current year's credit sales amount that we have not received yet. So that's 20,620. This results in the amount of 146,850. Okay, now for the second part, we need to calculate the total credit purchases for the year ended 30 June 2022. So we will be repeating a similar process to that of calculating the total credit sales. Let's have a look above. We can see that in this particular year, we paid 80,140 to the credit suppliers. And as we can see above, the trade payables for last year was 6,285. This just means that whatever amount that we purchased from our suppliers last year, we are yet to pay the amount of 6,285, which is also included in the amount that we paid to credit suppliers in this year. And since this is the credit purchases of last year, we should not be including this amount. So we're just going to subtract this amount of 6,285. And then we have trade payables for this year to be 8,520, which means that goods worth 8,520 have already been purchased from the suppliers, but we have not yet paid this amount, which means that we should also be including this value in our credit purchases, right? So the total is just going to be the total amount that we paid to the credit suppliers in this year. Then we need to subtract the credit purchases of last year, which is 6,285, and then we need to add the credit purchases amount made this year, which have not been paid. So that's 8,520. Let's write it down. We start with the total amount that we paid to credit suppliers, that's 80,140. Then we subtract the previous year's credit purchases, which was of 6,285. Then we add the current year's trade payables, so that's 8,520. This gives the total credit purchases for the year ended 30 June 2022 to have the value of 82,375. All right. Okay, for the third part, we now need to calculate the total cash paid for wages during the year ended 30 June 2022. Now, in order to figure out this amount, we will create a statement for our cash flows. Let's have a look above. We are given cash at the beginning date as well as the ending date. So we'll start with that of the beginning date. And the amount we have is 240. Let's write it down. So that's 240. And out of this amount, we paid out cash for wages, right? So that's minus cash paid for wages. Since this is a cash outflow, all of the outflows will be subtracted and the inflows will be added. Okay, now let's have a look at other cash transactions. The very first one we were given was the total cash sales for the year, which brought in 15,280 of cash. So this is definitely a cash inflow, which should be added in our statement. So that's plus 15,280. Let's write it down. Okay. And then we are told that Reese took 450 per month drawings before the cash sales were banked. So the total annual drawings would be 450 times 12, which results in 5,400. And this is the amount that Reese is taking for his personal use, which means that the amount is being deducted. So this is basically a cash outflow, which should be subtracted in our statement. Let's subtract it. That will be minus 5,400. Okay. And then We're also told that the cash sales were banked, right? And when we put our cash into the bank, the cash in hand decreases. So that is a cash outflow basically. And in this case, we have the total cash sales banked to have the amount of 7,170, which means that we can consider this amount as a cash outflow. So we need to deduct this amount in our statement. Let's write it down. That will be minus 7,170. Okay, I don't think there is any other cash transaction. Yeah, we have recorded all of it, so we can now just equate this cash flow to our ending balance. And the ending cash balance was given to be 110. Let's write it down. So this will be equal to 110. Now we can easily solve this equation in order to figure out the cash paid for wages. That is just going to be 240 plus 15,280 minus 5,400 minus 7,170 minus 110. And this results in our cash paid for wages to have the value of 2,840. Now let's move towards the fourth part. We now need to calculate the depreciation charge for the year ended 30 June 2022. Okay, let's have a look above. We were told that the depreciation policy is under the reducing balance method, which means that we need to charge this depreciation rate of 15% to the net book value rather than the cost, right? And we are also given the opening dates cost as well as accumulated depreciation. And in this year, we disposed a machinery worth 6,000, right? We can see right here that we disposed the machinery which had the cost of 6,000. And if we take a look at our bank account summary, we need to check if there were any new machinery purchased, right? And we can see right here that the new machinery was purchased, which had the cost of 9,200. So in order to figure out the cost at our ending date of 30 June 2022, we need to adjust the disposals as well as the new additions, right? So to the previous existing cost of 18,480, we need to subtract the disposed cost, which is minus 6,000, and we need to add the new machinery that we added and its cost. So that's plus 9,200. Let's figure out the cost. We'll start with the cost at our opening date, which was of 18,480. Then we need to subtract the cost of the disposed machinery, that's minus 6,000. And then we need to add the cost of the new machinery purchase, so that's plus 9,200. And this gives our cost at the ending date of 30 June 2022 to have the value of 21,680. Now we also need to figure out the accumulated depreciation. Again, we will be starting with the accumulated depreciation value at the opening date, which is given to be 9,685. Then the next step would be to subtract the accumulated depreciation of the disposed vehicle, right? And we already figured out the accumulated depreciation of the disposed vehicle right here. It was 1,665. And since there is no accumulated depreciation for new machinery, we can just completely ignore that aspect. And let's figure out the closing accumulated depreciation. We start with our opening value of 9,685. We then subtract the accumulated depreciation of the disposed machinery, which was 1,665. This results in the closing accumulated depreciation to have the value of 8,020. Now we already know that our depreciation rate is of 15%, so we can easily figure out the depreciation charge for the year ended 30 June 2022. We first need to figure out the net book value, which is cost minus accumulated depreciation. In this case, that will be the cost of 21,680 minus the accumulated depreciation of 8,020. And this gives the net book value. And now we are supposed to charge the rate to this value. So that's times 15%, which we can write down as 0.15. And this gives our depreciation charge for the year ended 30 June 2022 to have the value of 2,049. This concludes the fourth part. We can now move towards the fifth one. We are given additional information. Inventory at 30 June 2022 included damaged goods which had cost 1800 but needed repairs costing 350. The goods could then be sold for 30% less than the normal selling price of 2250. Alright, let's process this information. We have the previous selling price of 2250, but the new selling price will be 30% less than that. So the selling price is going to be the previous selling price of 2250 times 30% less. So that's 1 minus 30%, which we can write down as 0.30. And this gives our new selling price to have the amount of 1575. Okay, and we are told that these are the damaged goods. So whenever some goods are damaged, we need to subtract its cost from the total inventory value. And the cost is 1800, right? Then we can include its value at which it could be sold for, which is 1575. And it is only possible after the repair cost of 350, and costs are always to be subtracted, so that's minus 350, right? So the total change that we need to include in our inventory is going to be minus 1800 plus 1575 minus 350, which results in minus 575, which means that we need to subtract 575 from our inventory at the date of 30 June 2022. Okay. We now need to prepare the income statement for the year ended 30 June 2022. Let's do that. So according to the format of income statement, we always need to start with our revenue. So let's figure out our total revenue. That is basically cash sales plus credit sales, right? And in this case, we have the cash sales of 15,280, and we already figured out our total credit sales to be 146,850. Now we can just add these two amounts in order to figure out the total revenue. Let's do that. So our revenue will be the cash sales of 15,280 plus our credit sales of 146,850, which results in our total revenue to have the amount of 162,130. Okay, then if there is any sort of sales returns, we need to subtract it, but in this question there is no mention of sales returns, so we can just move towards our cost of sales, and we need to subtract our cost of sales. The very first item to be included in the cost of sales will be opening inventory. Let's have a look above. We can see that the inventory value at the opening date is 23,600, which will act as our opening inventory. Let's write it down. So that is going to be 23,600. Then the next step would be to add all of our purchases. Let's have a look above. We already figured out our total credit purchases to be 82,375. And if we have a look above, okay, there was no mention of any cash purchases. So we just assume that our total purchases is going to be that of total credit purchases. So let's write that amount down. We had the total credit purchases of 82,375. Then the next step would be to subtract all of the drawings, right? And we were given drawings regarding the goods as well. Let's have a look above. We are told that Reese had taken goods for his own use with a selling price of 350, but whenever we are subtracting drawings, we need to subtract the cost price, which we already figured out to be 280. So let's subtract this amount in our income statement. That is 280, and I'm going to write it in bracket indicating that this amount needs to be subtracted. Then the last item that we need to include will be to subtract our closing inventory. Let's have a look above for the value of closing inventory. We can see that at the ending date, the closing inventory had a value of 21,400, but we also need to make some amends to this amount since there were damaged goods. And we need to subtract 575 in order to figure out the correct closing inventory. So previously we had the amount of 21,400. Now we need to subtract 575 from this, which gives our new closing inventory value to be 20,825. And since this amount is to be subtracted, I'm just going to write it down in a bracket indicating that this amounts need to be subtracted. Alright, now the next step would be to figure out the total of cost of sales by adding these four amounts. That's going to be 23,600 plus 82,375 minus 280 minus 20,825, which results in 84,870. Again, we need to subtract this amount from our total revenue. And after subtracting the cost of sales from revenue, we get the gross profit. So the gross profit in this case is going to be 162,130 minus 84,870, which results in the amount of 77,260. Now, the next step would be to subtract all of our overheads. We also need to include all of our incomes or add the incomes if there is any. So let's have a look above for any sort of incomes. We only have the cash sales and the sale of machinery on which there was a loss on disposal. So that is also an overhead, which means that there is no incomes to be presented in our income statement in this particular question. So we can straight jump towards our overheads. So the very first overhead we have is a loss on disposal of 335. Let's write it down in our income statement. So that's going to be loss on disposal of 335. All right, let's have a look at our other expenses. We are given rent right here, and that's 12,250. We also need to see if there is any sort of adjustment to be made. And for rent, we can see right here that there was rent paid in advance at the ending date as well as the beginning date. Let's talk about the rent paid in advance at the beginning date of 1st July 2021. So this amount of 950 was paid for the year ended 30 June 2022, since this is paid in advance at previous year, but we paid it for the future date, right? So this is something that needs to be included in this year's income statement. So we should be adding this amount of 950. Now let's talk about the rent paid in advance at the date of 30 June 2022. We paid this amount of 1100 this year, but this is actually to be used for the future year ending 30 June 2023, which should not be included as an expense of this year. So we need to be subtracting this amount of 1100. So the actual rent to be included is going to be 12,250, which is the amount that we paid out. Then we need to add the rent paid in advance previous year, so that's plus 950. And we need to subtract the rent paid in advance for this year, so that's minus 1100, which gives the total rent to be included in our income statement to have the amount of 12,100. Let's include this in our income statement. So that will be rent of 12,100. Okay. Now the next one will be wages, and the wages that we paid out from bank was of 36,240, but also remember that we paid it wages as cash of 2,840. So we need to include both the wages paid from bank as well as wages paid by cash. So let's figure out the total wages. By cash, we paid out 2,840. And from bank we paid out 36,240, which gives the total wages paid to have the amount of 39,080. All right, then the next overhead that we have is of electricity amounting to 3,680. Again, we need to see if there needs to be any sort of adjustment made. And we can see right here that there was electricity accrued. Okay, so let's talk about the beginning date accrual. This is 420, and this is the expense for the year ended 30 June 2021, which had not yet been paid. But this cannot be included as an expense of this year since this actually belongs to previous year. So we need to exclude this amount. And let's talk about the accrual for this year. This is 380, which is of expenses for this year which had not yet been paid for. So we need to include this. So the actual electricity amount to be included in our income statement is going to be 3,680. We'll start with this amount, 3,680. Then we subtract previous year's accrual, that's minus 420, plus this year's accrual, that's 380, which gives the total electricity amount to be included in our income statement to have the amount of 3,640. Let's include this. So that will be electricity. with the amount of 3,640. Okay, let's have a look above for another overhead. We now have general expenses amounting to 18,590. Let's have a look above. There is no accrual as well as prepayment of the general expenses, and we were not given any sort of additional information, which means that we can include this amount of 18,590 in our income statement. Let's do that. That will be general expenses with the amount of 18,590. Now the final one we have will be the depreciation charge, which we already calculated to be 2,049. We need to include this in our income statement. That will be depreciation with the amount of 2,049. This concludes all of our overhead. Now the next step would be to figure out the total for overheads by adding these six amounts. That's 335 plus 12,100 plus 39,080 plus 3,640 plus 18,590 plus 2,049, which results in the total overheads to have the value of 75,794. And again, we need to subtract this amount, so I'm just going to put it down in a bracket. Now, after subtracting the overhead from gross profit, we get the profit for the year. And in this case, the profit for the year is going to be 77,260 minus 75,794, which results in 1,466. This concludes our income statement. All right. And we can see that we are given the working section right here. So instead of scribbling all over the question paper like I did in order to figure out the correct amounts for electricity, wages, and rent, you guys need to be showing all of this in the working so that you get your marks correctly for those steps. Okay, now let's move towards the sixth part of this question. We now need to state two causes of depreciation of non-current assets. So the very first one is wear and tear, because as much as we use those non-current assets, their value will decrease, right? So let's write it down. That's wear and tear. And the next one will be technological change, because if there is advanced technology that could accomplish some task in an easier and efficient manner, then the existing previous technology will be of lower value, right? That could cause depreciation. So that's technological changes. Okay, this concludes the sixth part. We can now move towards the seventh one. We now need to explain with reference to an accounting concept in each case why a business should make a provision for depreciation of non-current assets. So the accounting concept in use would be our matching concept. Let's write it down. And the explanation for this is that according to our matching concept, we need to match the cost with the revenue earned, right? And in case of our non-current assets, we need to match the cost of uses of the non-current assets with the revenue earned in the same year. So let's write it down. To match the costs of uses of non-current assets with the revenue earned in the same year. All right. Now for the second part, we need to state the accounting concept and explanation about why a business should make an adjustment for damaged inventory. So the accounting concept utilized is going to be the prudence concept. And according to prudence concept, the assets should not be overstated, right? And we're talking about inventory, which is also a current asset. So we need to make an adjustment for damaged inventory by reducing its value so that the value of current assets is not overstated, right? So the explanation would be to ensure that inventory or assets in general are not overstated. This concludes the seventh part. We can now move towards the next one. We are given additional information. Reese has been thinking of maintaining a full set of accounting records. Previously, he did not maintain a full set of accounting records. Now we need to advise whether or not he should maintain a full set of accounting records by justifying our answer. So if he is to maintain a full set of accounting records, it would definitely enable him to monitor and control all of the incomes and expenditures, right? Let's write it down. A full set of accounting records would enable Reese to monitor and control all income and expenditure and while monitoring and controlling all income and expenditure, it would definitely avoid the occurrence of irrecoverable debts. Let's write it down as well, which in turn should avoid the occurrence of irrecoverable debts. But Reese may not have the necessary skills or the time to maintain a full set of accounting records, right? And if that is the case, then there might be some additional expenditure which will reduce the profit while employing skilled services. Let's write it down as well. Reese may not have the necessary skills or time to maintain a full set of accounting records and this may involve additional expenditure and reduced profitability in having to employ skilled services. All right, now based on these factors, we need to give advice to Reese. So I would definitely advise him to maintain a full set of accounting records because that is the correct way to run a business. Let's write down the decision clearly. Reese should maintain a full set of accounting records. All right, this concludes the 8th part of this question as well the entire question number 1 of 2022 October-November paper 2-3. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.